Okay, we're going to get started here. First of all, I want to welcome everybody to our webinar tonight. This is part one of a three-part webinar we're going to be doing. And this first part is the foundations of investing in multifamily syndication. I've spoken to many of you before, and one thing I reiterate with everybody is my goal and the goal of my team at Break of Day Capital is we want everybody to be as comfortable as possible and excited to invest with us. So unlike the 2024 outlook that I did with my colleague Joe Fang, where we wait to the very end to take questions, this one we're going to be taking questions throughout the presentation. So when a topic arises and you have a question, please enter it in the Q&A box at the bottom of the screen. You'll see that interactive Q&A. That's the best. That's where you need to enter your questions so we can answer them. So we're going to get started here. I know many of you know me, but just a quick background about myself. I spent 20 years on Wall Street. When I was on Wall Street, I was an institutional sales trader. I covered hedge funds and mutual funds and family offices. And right before I joined Break of Day Capital, I was a multifamily realtor in Arizona. I did deals throughout the state, and that's actually where I first met our CEO and operator, Gary Lipsky. And what I love most about this job is building connections, relationship building, and helping investors realize their financial objectives through real estate investing. So that's my goal. So just a quick company overview about Break of Day Capital is Break of Day Capital, we focus on acquiring underperforming multifamily properties in the Southwest. And once we acquire them, we reposition them. We institute best in practice and management. And our goal is to improve the value for the shareholders. Gary Lipsky, he's written a book called Best in Class. I really recommend everybody check that out. It's an excellent read. He hosts a weekly podcast. And we were recognized in 2023 by the American Apartment Owners Association, which is 140,000 members strong, as the best real estate syndication company. And in just over 4 years, we've acquired over 1,300 units with a value above $250 million. So as I mentioned, this is the fundamentals webinar we're doing. And one question we get asked a bit is, what is a syndication? We're going to start with the basics. A syndication is a partnership between an operator and investors who pool their capital to fund a real estate purchase. Often it's referred to as passive real estate offering or a private placement. And this chart here on the left explains it. So you'll see a property. The general partner, also known as a sponsor or operator, identifies a property he wants to acquire. Once he identifies that property, reaches out to limited partners and pools their money to finalize the acquisition of the property. So why invest in a multifamily syndication? What's great about a multifamily syndication is, first of all, passive investors. You don't have to do any of the work, get to receive all the benefits of investing in real estate. The second point I think is really key is the economies of scale. If you were to invest in a syndication as a limited partner, you have access to a much larger property with a lot more upside and a lot more meat on the bones. One thing I found in multifamily when I was a realtor was the smaller properties, while you invest and you still make money, never had the economies of scale or the upside potential as larger properties do. So this gives you access to these larger properties one normally wouldn't have. Also, when you invest in a multifamily syndication, you get to leverage the expertise of a professional operator who's doing this for quite some time, has amazing relationships, has favorable financing, and the operational skills. has done this before and knows how to improve a property to boost shareholder value. As a passive investor too, you're limited liability just to the amount you've invested into the property. And one thing I think is really key too about multifamily syndication and investing is diversification. Diversification is a term you hear quite frequently. And it's usually, when I was on Wall Street, a lot of financial planners used to love to say diversification, and you need to diversify your portfolio. But what they always meant was they wanted you to take your money and put it in different sectors, put in the tech sector, healthcare sector, consumer staples sector. But as somebody who worked on Wall Street, saw the returns of the stock market, is now involved in real estate, I cannot stress enough how important it is really to diversify your financial portfolio to make sure that real estate is a percent of that portfolio. You get a much steadier returns, less downside, it's recession resistance, and it's not whipsaw. There are not months where you get your monthly statement where your stock portfolio is down big, next month up big. You don't have to deal with that, being whipsawed in the market. And one thing that's really interesting about multifamily investing and comparing that to the difference between investing in multifamily versus buying a second home or even a rental home is a multifamily property, the value is based off of the income it generates, not comparable sales like single family residency. So what I mean by that is if you own a single family residency, you could be renting it out and doing quite well. However, when it comes to the value of the property, it's based off comps, sold comps in the area. So if, let's say, a month ago, you're a single family residency in your area, similar size, similar square footage, sold for $1 million. But a week later, similar property sold for $800,000. Your property's worth $800,000. It's based off that sales comp. That does not happen with multifamily investing. If you own a property, let's say you own a 10-unit property and there was one right across the street, same condition, same amount of units, same size, same amount of property. And let's just say you had a mental number based off the net operating income, the amount of money the property was making. And your property was making $100,000 and the property across the street was just generating $75,000 of net operating income. And we're going to get into net operating income in a minute. If that property across the street sold, let's say as I said, you had a mental note, your property is worth about $2 million based off that income. And the property across the street sold for $1.5 million, but was generating just $75,000 worth of net operating income. Your property would not be all of a sudden worth $1.5 million. Investors are not going to care what that property sold for. They're going to look at how much money that property was generating. So your property that's generating more net operating income is not going to take the hit as a result of that sale across the street. And what's great about the NOI is this is something too that you can force appreciation. And we're going to get into some examples of that in a minute in our next presentation. But we do have a question here.
Yes. So the question is, you say limited liability, but what if there is a capital call?
Yes. So the capital call, what a capital call is when a property is underperforming and people, if the property is underperforming and the investors come back and come back to you and say, hey, the capitals, we're underperforming and we need to raise more capital. Breakup day, we never had one for the record. But in a case like that, again, you're just limited. You can tell them no. And in that case, it said your liability is just limited to the amount you've invested. You don't have a higher liability if there is a capital call to the property. Your liability is just limited to the amount you've invested into the property. Is that it for questions right as of now? Okay.
Yes.
So we talked about NOI. So what does it stand for? Net operating income, NOI stands for net operating income. And what this measures is, and the way it's measured is you just take the revenue generated and then you minus all the expenses attached to it. So let's say you take all the revenues that were coming in and then you take out loans, capital expenditures, mortgage payments, depreciation, and the number left is your NOI. The bottom here is just an example. If the property was generating $2.5 million of revenue and the operating expenses were 1 million, you'd have $1.5 million worth of NOI. Now, why is NOI so important? Well, one, it determines the profitability of a property. And second, when a lender looks at a property and decides whether or not they're going to loan or not, that's one of the first things they look at, the NOI in the property. And third, and we're going to get to this in a little bit too, it helps calculate the cap rate. And we're going to get into cap rates in a bit as well to go over that. Now, we mentioned you can drive NOI to boost the value of your property, unlike, single family where you're based off sales comps. So how is NOI driven? Well, one, you can increase rents. That's the biggest one. All multifamily properties, rent is the biggest source of revenue for the property. But you can also introduce additional streams of income. Covered parking is a good example. We have a property in Tucson, and recently we sent an email to all the tenants saying who wants a covered parking place. They were gone less than 48 hours. They were all gobbled up, charging the tenants, $15, $20 a month for a covered parking place. Laundry revenue is another great one. A lot of the almost all the large properties, I should say, have a laundry room on the property. And pets, pets is another example of things. A lot of, most properties, there's almost certain to have a significant amount of people who have a pet to charge them a fee for that. And the flip side of driving NOI is decreasing expenses. And utilities is one. Some places have too many people on site. You can reduce that as well. And I'm going to get into a good example in a little bit. But at Break of Day Capital, an objective we've had and we've accomplished is being able to boost NOI on average 40% the first year through projects. And I'm going to get into a very interesting one about water conservation on the next page. So water conservation. Now, this is a way that we've driven and are going to drive NOI on our most recent acquisition. When we were doing the due diligence on this property and looking at the books and records, one item that really caught our eye was water usage. The number was off the chart and didn't make any sense to us. And upon visiting the property, we realized that the toilets use about 3.5 gallons per flush. That's what the GPF stands for. And the replacements will use just 0.8 gallons per flush. Showers, we're using 2.5 gallons per minute. That's what the GPM stands for. And the replacements, adding aerators, would reduce that to 1.5 gallons per minute. The hard number that this is going to save the property is $138,000 in operating expenses the first year immediately. So what does that do? Driving the NOI $138,000 that first year is going to boost the value of the property by $2.8 million right away. So what is a cap rate? That was a term early in the presentation that I said we're going to get to. When I was a multifamily realtor, when I called somebody and said, hey, I got a property for you, there was two questions they always asked. The first one, what's the price? The second one, what's the cap rate? So the cap rate is calculated by, you take the net operating income, the bottom line, and divide it by the price or the current value of the property. So I want to take, I'm going to skip over the middle part for now. And at the bottom there, you'll see that if a property was valued at 20 million, was asking 20 million, and the property was producing 1 million of NOI, you take that 1 million, divide it by 20 million, and you get a 5% cap rate. So when it comes to cap rates, people often ask, what does a high one, what does a low one mean? Well, a higher cap rate indicates that the expected returns from the property are not as great, and people are going to pay less for such a property. And the higher cap rate indicates there's much lower growth potential. Now, for example, take a state like Iowa. Iowa actually is losing population. And if you were to buy a multifamily property there, you're going to see a higher cap rate because you need to attract investors to a property that's much more risky. While the lower cap rate is the exact opposite. It's a less risky property. Investors are willing to pay more. And it usually indicates that there's a lot more growth potential. Take, for example, Phoenix or Tucson, just Arizona as a whole, you're going to see much lower cap rates as people view this as a much less risky market as we continue to see good population growth. So what is cap rate compression? Now, this is a term people often hear about as well. Cap rates, what's going on? Are they going up? Are they going down? What's interesting about cap rates is they're not fixed at all by the market or the sector. They increase, they decrease, really part of the changing conditions in the markets. But the biggest part of cap rate movement is fundamental change in the markets. For example, take Arizona. As I started off as a multifamily realtor, I saw cap rates come in quite a bit. And the reason being just Arizona is a really solid market. We're seeing income growth, population growth, lack of supply. And that's really one of the drivers when it comes to cap rates getting lower and lower as values get higher and higher. People often ask about interest rates. Do interest rates influence cap rates? They do, but it's not nearly or significant as much as fundamental changes to the market. Do we have a question? I just saw the...
We have a couple questions. One regarding the water conservation project. The question is, why is 138,000 2.8 million in value? Is that the standard multiple?
Sure. Well, I'm glad actually we got to cap rates to explain. I have to go before we answer that question. So using a 5% cap rate, so the $138,000 of net operating income, if you divide that by 5%, you're going to get to $2.8 million rounded up as a number. So that's how we've calculated that $138,000 of savings is going to boost the value of the property approximately $2.8 million.
All right. And the next question, is there a minimum cap you require, or is it based on the value add that you see?
It's mostly based on the value add we see. The cap rate. I mean, as I said, if there's cap rates that are extremely low, but there could be enormous value add of the property. So yes, we do look at the cap rate and take that into account. But the most important item to us is really just being able to drive and boost the net operating income to a level we need to see. So understanding the different return matrices. We're going to go over each of these individually, but these are four you often hear in real estate. Cash on cash, COC, AR, which stands for the average annual return, the IRR, the internal rate of return, and EM, which stands for the equity multiple. So cash on cash return. What this number does is it calculates the average or the income that an investor will receive pre-tax relative to the amount they've invested into the property. So if you invest $100,000 in the property, and that in the year you get a $4,000 distribution, well, what happened is you take that $4,000, divide it by 100,000, and then of course multiply by 100 to get that 4% number. Now, what's very important to know about cash on cash return, I started with this one because it's the least important one to really take into account when looking at a multifamily investment opportunity. The value add multifamily deals usually do not have high cash on cash returns. They offer higher appreciation, much significantly appreciation at the end of the deal. And one way to really look at this is, take a stock. You purchase a stock because you really want it to appreciate in value. You really don't, I mean, if a stock pays a dividend, great, but you really own it for the appreciation. And that's the same with multifamily. If it pays a dividend or a distribution, great, but your big return is at the very end when you sell it. Now, for sport today, I just checked out a couple very well-known stocks to see what their distribution was. Berkshire Hathaway, we all know Warren Buffett. Berkshire Hathaway, their annual dividend is 0. NVIDIA, one of the biggest high-flying stocks in the market the last couple of years, their dividend, the stock is $887. They pay 16 cents in distributions. So if you own those, you're owning them because you want the stock to appreciate. Same with multifamily. Distribution is great, but definitely not something to be focused on. Do we have a question, Jacqueline?
Yes. How do fluctuations in cap rates impact or not impact medium to long-term buy and hold investors?
Good question. So we definitely take the cap rate, into account, when we're looking to divest it. We certainly, we obviously want a cap rate to be on the low, small as less as possible when we look to divest a property. But we're sort of our hold period is 3 to 5 years is sort of our target hold period with our properties. So we will take that into account, the cap rate of what people are looking for at the market when we sell. But the market, cap rate in Arizona has not swung too much as a whole. So it hasn't had so when it comes to that the investing of the property, one thing that we are going to take into account, but we're pretty confident when the property is time to sell it, we are going to get the price we want, primarily due to the boost of the net operating income that we're driving right now. Any other questions at this time?
Not right now.
Okay. So the average annual return, the AAR. So what this is this calculates the return over a period of time based on a time-weighted annual percentage. So the example we give below is, let's say the property gives you a 2% distribution the first year, 3% the next year, 4%, 5%, and then the big divest, when the property is sold, you get an 86% return that year. To calculate it, you just add up all 5 of those numbers and then divide by 5 because it's 5 years, and you get a 20% average annual return on it. Now, one of the big questions people often ask is the difference between average annual return and the internal rate of return. I'm going to get to that in 1 minute. So the internal rate of return, the average annual return, as we mentioned, just gives you the return annualized over a fixed period of time. But what the average annual return does not do, that the internal rate of return does do, is takes into account the time value of money. You own $1 today, it's going to be worth less a year from now, primarily due to inflation. So the internal rate of return factors that into the equation. And so when it comes to multifamily, if you invest in a multifamily syndication, your money's tied up until the property is sold. So it isn't a liquid investment. So based on that, the internal rate of return is much more applicable than the average annual return. Now, the internal rate of return, unlike the average annual return, where it's a pretty simple math equation, the IRR is a little bit more complex. A lot of letters, numbers, Greek symbols involved in that one. So rather than show that to you, if what's great now is these days, all these formulas are calculated for us. And if you do ever want to calculate the IRR, you can go to our webpage under Investor Tools, breakitdaycapital.com, Investor Tools, And there is a calculator there where you can type in your initial investment, expected returns each year, and it'll calculate the IRR for you. Now, the equity multiple. This is one of the key numbers that you should be extremely focused on when you're looking at a multifamily investment opportunity. So the equity multiple describes how much money a commercial real estate investor can earn compared to their initial investment. It just uses two figures, your cash distributions and the total equity invested. So your equity invested number, that is the bottom line. Your cash distributions at the top line. So if the cash distributions in this case is $2,500,000, you would divide it by 1 million and you get a 2.5 times equity multiple. Your money's increased more than 2.5 times. And since multifamily, as I said, it is a number, your money's tied up. This is one of the key metrics to really look at. Now, what is a preferred return? In a lot of these presentations, you'll see with us, minimum investment, and right underneath there is the preferred return. And a lot of people see that preferred return and they think, oh, wow, I'm going to get that amount of money back every year. That's not the case. A preferred return is not a guaranteed return, but instead it's a hurdle. It's a hurdle the sponsor must clear before they can start sharing the profits with the investors. So preferred equity gets paid before common equity. And what's important to know about all of our investments is when you look at those numbers, before break-of-day capital gets a penny of the profits, we return the investors their entire initial capital investments. And then right after that, we give them the preferred return before we get paid. I see there's a question that just came in.
Yes. Is the biggest factor driving the equity multiple outside of distributions the fees that the sponsor GP collects, and that carries a big variable?
I'm sorry, can you repeat that one more time?
Yeah, is the biggest factor driving the equity multiple outside of distributions the fees that the sponsor GP collects and that carries is a big variable? I don't know, if, Anthony, if you want to maybe clarify that a little bit. Are you just asking is the biggest what the biggest factor is that is driving the equity multiple?
Yeah, say second question came in. Has it been a follow-up?
Yeah, he's going to clarify for us.
Okay, perfect. Yeah.
Do you want to move on for a moment while we wait?
Well, I'll just say one thing about the equity multiple. Really, the driving factor with the equity multiple is really driving that NOI, and that's how we really boost the value of the property is through the NOI. So that's once the NOI is boost, you applying that as you saw the $138,000 boost the value of the property about $2.8 million. Really, the boosting the NOI is really how we really get that equity multiple to keep on increasing. Is there another question in there?
When evaluating equity multiple, I see varied equity multiples, and when looking at fees, that seems to be a big factor. Not sure this is an appropriate question here and now. Anthony, I'm assuming you're talking about the like acquisition fees and such that a sponsor is okay, yes. So fees that a sponsor charges.
Oh, does that really drive the equity multiple? Well, I'm going to get into in a little bit the way the numbers are split up. Looking at the numbers and the returns on it. So why don't we get into that first, and we'll definitely address that question. Hopefully that addresses the question, but if not, we can certainly try address it towards the end of the call. So, but Jacqueline, was there another question that came up? I just saw something else.
No, we're good.
No? Okay, perfect. Okay. So as I was saying, when you see that preferred return number out there, we return the investors, their entire initial capital, and then the preferred return before we get paid. So we have that big hurdle there to the investors before Break of Day Capital sees any of the profits. Now, in our pitch deck, this is a slide. I'm going to go over the two classes, the Class A and the Class B, and how they differ. But when you look at a pitch deck, you'll often see these investment options: the minimum investment, preferred return, the waterfall, and again that too, a bit as well. So we'll go over this. Sorry. So when you see that 10% preferred return asset class, what does that mean? So in that class, cash flow is distributed to investors until they receive the annual return of 10% based off their initial capital contribution. If you invest 100,000, you should expect $10,000 back, 50,000, 5,000 back. So that preferred return is also important too, is the position of where they lie on who gets paid at what time. The preferred class investor is positioned right behind the lender, but ahead of the common equity. So they're second in line to get paid back with the cash flow in exchange for that fixed return. Now, before we go into that Class B class, you saw in there's a term called waterfall. So what is a distribution waterfall? In multifamily syndications, what a waterfall does, it describes how and when and whom the funds are paid for in the deal. And the type of waterfall determines the returns to the investor and the sponsor. And I'm going to get into an example of that in this next slide. So as we mentioned in that one slide, there's a 7% preferred return and then an IRR hurdle in that preferred class, or sorry, Class B. So what that means is, in this class, in addition to getting your initial capital back, the cash flow is distributed to the investors until they receive an annual return of 7% based on their initial capital contribution. After that 7% accrues every single year. It's not a one-time only number. It's each and every single year, a 7% preferred return. And once that number is achieved, what happens is the remaining cash flow is split, with 70% being paid to investors and 30% paid to the sponsor and their team. But as I said before the sponsor and the team gets any of the profits, 100% of the initial investment is returned to the investor. Now, often in these pitch decks, you'll see that there could be more than one. There could be a second hurdle. And in this case, there is. So it's a 70-30 split, 70% to the investor, 30% to the sponsor, up to the 15% IRR. Once the 15% internal rate of return is achieved, it's a 50-50 split in the profits after that. So a really good question we often get asked is, what happens to the preferred if distributions are paused? Well, this is outlined in all the legal documents that preferred returns are cumulative. So as I said, that they just keep on being cumulative down the road and down the road. And if the distributions are paused, it's not a cause for alarm by any means. There was a great line that somebody once responded to when asked, what if the distributions are paused? They said, "We're not a Ponzi scheme. If the contributions are not there, we're not going to we're just not going to pay them and let our investors know." And issues come up with multifamily, and sometimes distributions have to be paused. And In that case, all it means is that your preferred, as I said, your preferred return is cumulative, and this is taken into account at the very end when the property is sold. And if at any point there was expected preferred return that was paused, it'll be made up for at the very end. And it's actually a very wise thing for a sponsor to pause and refrain from distributions when there is an absence of income. Now, here's a good example of how what to expect with returns in an investment. Now, this projected returns is based off a $100,000 investment, and in this case, the investor gets the first year a $2,000 annual distribution, and it goes up a percentage point each of the next few years. It goes to 3,000 year 2, 4,000 year 3, 5,000 year 4, and another $5,000 in year 5. And in year 5, the property is sold. So the investor is returned the initial investment, $100,000, and the proceeds from the sale to the investor is $81,000. And that $81,000 that is after fees that the sponsor would have collected. That's not before fees, that's after fees. Important to note that. So add those all up, your return is $200,000, which, as I said, divided that by your initial investment, that's a 2 times equity multiple. And this is just an example of what the returns look like in a multifamily investment. So another item you'll often see in a multifamily pitch deck is a sensitivity analysis. So what is that? What a sensitivity analysis is, it's a stress test. And it shows you a chart of sort of a base case. There's usually a base case of what the operator expects to happen. And then there's a best case scenario, worst case scenario, and it just shows you what your returns would be based off of that. I see one question came in. We'll answer that before I get to showing you an example of a sensitivity analysis.
Yes. So 2 times in 3 to 5 years, that's a big swing in time. What drives that?
So what really drives the equity multiple, as I said, our goal with our properties, especially the one we just last closed on, is to double our equity multiple target for most recent acquisition is 2.07 times. So what drives that really is the net operating income increase. And I'm just going to give you an example of this last property we closed on. So how we expected to get you as an investor a more than 2 times equity multiple is, we gave you examples of how we're going to drive NOI. The first one's always rents. The properties that we acquire, usually we see rents well below market. The last one, they were anywhere from 18 to 25% below market based off the unit size. We already went over the water utility savings. That is a huge number that's going to save that adds $130,000 to the bottom line immediately. But then there's other items as well. We talked about other sources of income. In this, there's pet fees that we're going to charge. There are covered parking that we're going to charge. And in properties too, we always look for additional ways to boost rents as well. One of our properties, we're going to add a little privacy wall to the first floor units to give them a little privacy. That should boost rents as well. So there are a lot of items to boost it. But as I mentioned before, the net operating income is really what drives the investments. And at break-even day capital, our goal is to boost it 40% the first year. So how to read a sensitivity analysis. So as I mentioned before, there's a base case, and then you look at worst case and best case scenarios on this one. And this here is just an example. This is not related to any property we have currently, but in this case, the operator, the top line. Actually, before I get into the operator's base case, I'm going to explain how to read the lines on this one. So the top line, the bold numbers represent the vacancy rates. And on the left in bold is the exit cap rate numbers. And the numbers in the middle, you'll see on the left side is the internal rate of return. The right side is the equity multiple. So in this case, the operator's saying, okay, he expects about a 5% vacancy rate. And when he sells the property, the cap rate to be, is 5.35%. And under that scenario, they would achieve an 18.3% internal rate of return and a 1.7 times equity multiple. Now, with the sensitivity analysis, you can sort of factor in the worst case and best case scenario. So the worst case scenario would be if you look on the right side, the lower corner there, you'll see if the vacancy rate is 8% and the cap rates are getting higher and it ends up being 5.8%, the internal rate of return would be 10.7% and a 1.4 times equity multiple. Now, the best case scenario is the opposite corner. If you look on the upper left corner, you'll see if the vacancy rate was 3% and the the exit cap rate was 4.9%, you're looking at an internal rate of return of 24.3% and a 2 times equity multiple. So this model just gives you a very good idea of what to expect, worst case, best case scenarios. And you can adjust it yourself. If you think there's gonna be higher vacancy rates, but a lower cap rate, you can look at the upper right corner. And same way too, if you think there's going to be lower vacancy rate but higher cap rates, you can look at the opposite corner as well, the 15.8 and 1.6 times. But this is just a very good number to keep in mind to let you know what the operator's thinking and to price in best case, worst case scenarios. So that is it for the presentation. I'm sure there are a lot of you have questions to ask. We're going to take those. But one thing that's really important here is, as the investor relations manager, as I mentioned before, my goal is I want everybody I speak to be as comfortable as possible and excited about investing in multifamily real estate. So I'm here to answer any questions. You can email me at adam@breakofdaycapital.com, or you can call me at 602-529-2056. And if you like to, we can certainly set up, if you need to schedule a call, we can do that as well. But that's what me and my team here to do. We want you to be very comfortable and excited to invest with us. So we do that through answering questions. So any questions at this point?
Did you want to go back to Anthony's question regarding the equity multiple and just what fees that we charge versus how others might charge more, and that'll affect it?
Oh, sure. He's just talking about standard fees that we charge. Yeah. So when we acquire a property, we take a standard, and it's most operators do this. We do take a 2% acquisition fee, and then 2% of the monthly rents, just to keep, as we said, to keep the lights on is I guess the way a lot of people describe that. That's our standard fees. And then after that, as I mentioned, we as a company only get paid if those that preferred hurdle is achieved when we sell the property.
But other sponsors do charge more that can affect it.
Oh yes, some do. It's not uncommon to see that number significantly higher. But so definitely a good question to ask a sponsor.
Okay, so we have some more questions coming in. What is the lowest level of investment do you allow in your syndications?
Yes. So right now, the lowest we'll accept is $50,000.
Okay. And there's a question, will this presentation be available for us to review it? Yes, I will be sending out an email to anybody that's registered and provide the recording. Okay, so are your syndications 506B or 506C offerings?
Ours is for institutional class only. So ours is 506C.
But we don't always,
Sorry,
we do offer
accredited
some
investors.
506. Yeah. Our current offering is a 506C.
It is,
But
yeah,
we do have in the past and in the future, we will have open to non-accredited investors as well.
Yes.
Will investors have the depreciation tax benefit?
They will for some deals. The deal we just closed on recently, because that was closed on in 2003, that will not have it at this point going forward. But future deals for certain will do have a bonus appreciation element for investors.
All right, so this is a great one. Last question. Are preferreds returns year one like you showed?
Well, the preferred you're asking the class. Well, the class A preferred that shows you the 10%. Yes, that return will be paid out that first year. The 10% preferred class, they get that 10% paid to you on a monthly basis. The class B, where there's a 7% preferred hurdle, that class you will most likely not see that 7% preferred number pay the first year. The first year for our the deal we just closed on, we expect to give investors back probably about $2,000 starting in Q4. So that hurdle's not going to get crossed this year. We expect that distribution to increase every single year, but you're not going to see that 7% 7% distributed to you every single year. In fact, most likely you're not going to see that number achieved until the very end when the property is sold. That's where the big upside is going to be with our most recent acquisition.
Which markets do you invest in?
So the deals we've done so far have been in both Phoenix and Tucson, but we are looking at the entire Southwest region right now. We are looking at states like Nevada, New Mexico, Colorado as well. So we're open in the Southwest, but Brigadier Capital's acquisitions so far have just been in Arizona, primarily Phoenix and Tucson.
Okay, we just had another one. When you acquire a property, do you know when you will sell it?
We don't know exactly when we will sell it, but the normal hold period for our properties has been 3 to 5 years. That's primarily the window in general with multifamily. Some properties that we've owned, we've only held them for 2 years because they appreciated that much that quickly. But I would say normally it's about a 3 to 5 year window is when we look to sell a property after we acquire it.
What is the trigger to sell?
The trigger to sell is really when, as I said, we really driving the NOI. That's really the biggest thing with a property. We try to boost it up 40% that first year. So when you acquire a property, usually the first thing you do, they always say there's the stages. You acquire it, you renovate it, you stabilize it, you sell it. So usually the trigger to sell a property is when we've boosted the NOI as much as we think we have. We've done most of the heavy lift in the property. That's when we start to look to divest the property.
How are your projections affected if interest rates continue to rise?
Well, if interest rates continue to rise, we're in good shape. That's not going to change things. The interest rate we have on our property right now, we've locked in the rates. As I said, one of the key things, and that's a great segue into in 2 weeks, the next webinar we're going to be hosting about vetting the operator is we looked at a lot of different opportunities and options when it came to financing the property. And what we thought was the most important thing to do was lock in the interest rate. By doing so, we're protected to the upside. Well, I do think rates are going to go lower. If there was some sort of event that caused rates to go higher, we're protected. And at the same time, too, currently the loan we have in our most recent acquisition, there's no prepayment penalties. If all of a sudden a big offer came in to sell it, and so that's one of the key things there too. And also we can refinance it. So if rates do go lower as expected, we have the opportunity to refinance it. So if it comes to rates going higher, we're very well protected right now.
Okay, can an investor decide to use a 1031 exchange by investing into another syndication property of yours?
Yes, they can. There is an option to 1031 into one of our properties. But if you want to do that, it would have to be a future property. The property that we just closed on, because it officially closed, that's not doable at this point. But future properties, there will be that opportunity to do that.
Are you a vertically integrated operator or are you a fund of funds?
We're vertically integrated. We don't we're not a fund to fund organization.
Oh, we got another one. Okay. Will you consider ground up if vertically integrated?
Um, Ground up is not something that we really focus on. There is one property in our portfolio that we did do some ground up, but it was not the initial investment. The initial property, we converted some commercial space to individual units, and the property presented itself the opportunity to build up, do some ground up addition to the property. So we will consider ground up as just sort of an add-on, but we would not look at just an opportunity to just do immediate, just barren land build up is not something we look at
Okay. What are your overall objectives?
with our property. Okay. Um, well, with our property, as I said, the big one with us when we choose to acquire property is we want to be certain that we can boost that net operating income about 40% the first year. That's really our key objective when acquiring a property. And I used to like love to say a story of when I was on the other side showing properties. Anytime I had a big one, I called Gary, and he passed on every single one that I showed him. And the reason being is, he did not just never saw the growth potential in these properties. So that's really the key one for us is being able to boost the net operating income 40% in these properties. So we normally target, that's the big number for us, I would say. The properties, normally we target an equity multiple of north of 2. And we target like a high teens internal rate of return and a low 20s average annual return. Now that I've explained those terms to you guys, so we can go over them.
Say someone invests 100,000, what will be a reasonable return each year? Then say when the property is sold. Of course, no guarantee.
Oh, so they're asking the returns. It mumbled for a second. They're asking what the returns would look like.
Yes, like what a typical targeted return would be.
Sure. So that one slide we did earlier in the show that said, the first year getting that the 2, 3, 4, 5, 86, that's probably a pretty good representation of what to expect. The last deal we just closed on, we're expecting about, to give investors most likely starting in Q4 this year, if they invest $100,000, a $2,000 distribution. The following year, most likely it's going to go up 1,000 or maybe two, to the 3 to 4 range. The next year, the following year to 4 to 5 range. And then when we sell it, it's going to be the very big, large distribution. We're targeting just over a 2.07 times equity multiple on this property. So distributions would look a lot like that. It would be, as I said, that's 2, 3, 4, and then that would be then probably another $100,000 distribution plus your equity, your initial investment back.